Good evening, everyone, and welcome to today's webinar, The Fastest Way to Consistent Profits. We will be going into the webinar in a minute. First, let's a quick word about the host, CMSTRADER, broker that you may well know. Been in the market for quite a while now. If you haven't had any account yet in the past and looking for your first account, they're an excellent starting platform. Now, that said, let's just get right into it. So in today's webinar, we're going to be discussing the fastest way to consistent profits. However, we're going to go over an introduction. I'll introduce a little bit about myself, who I am, what I do. We're going to go over the basics of a trade. We will then transition into we'll touch bases on fundamentals a little bit, what they are and how they work. We will then go into some technical analysis where I will show you a little bit of basic technical analysis that you can use as a foundation to start with for the really new people. And then we'll have a Q&A session after, which is allocated 10 minutes, but can be longer, can be shorter. It depends on the questions that we get. All right, so first of all, who am I? Well, like I said, my name is Mike Rotink. I've studied at the Cambridge University for international business, and what I did there, as I figured out that I was good with numbers, good with analysis, as a hobby, I was doing things like chess and obviously some outdoor activities. But the one thing that I all of a sudden ran into was just obviously, the internet was coming up and everything. I ran into something called Forex, and I basically got hooked from day one. I thought it was exciting. I thought it was interesting. It was kind of combining the fact that I'm good with numbers and that I could do analysis on it and I could play around with it. And I started understanding how it worked and what you had to do. Well, that was good in theory. So that was 11 years ago. Now, the first 3 years weren't the best. We were best years. At first, a little bit paper trading. Then I transitioned to my first live account. That didn't work out. Second live account was okay. It was kind of like stable, but didn't really get anywhere either. And then in the third year, somewhere the penny dropped. I figured out what I did different, what I had to do different in order to be in that 10%. And that brought me to what I do now. Since then, for the last 8 years, I've been making consistent profit on a yearly basis, and has allowed me to work with several large brokers as a consultant, as account manager, and now that I transitioned to myself, I present these webinars, I give one-on-one coachings, and I train larger institutions how to do analysis and so on and so forth. So let's look at the basics of a trade. Well, the first thing that I have on my list, and that is for me the most important part, is psychology. And the reason I put that on the top, because this is where that penny dropped for me. The way that you think about approaching your trade, the mental status that you were in before trading on your live account, all these factors contribute to the success of your trading. Having the confidence, committing to your trade, not doubting your own analysis. It's a matter of confidence and being able to make a decision and act on it. A lot of people wait way too long. You will see a lot, okay, well, I think it's going to do A, B, C. What you see then is you don't act on A, B, C. What you do is you wait for you seeing that A is completed and it starts doing B. And at that point, you go in for B to C. That means that the whole trajectory of A and B and a starting point of B to C, you already missed. You should have already been in that trade from the moment you decided what point A to B was going to be before even deciding what the ultimate point was. This brings us to entry moments. A lot of people look at entry moments and find it very difficult to find them. I will show you later on in the webinar how with technical analysis you can find entry points that are most suitable where the probability of success is highest. This is what you wait for. Most of you as beginners, some of you might be veterans, you might be struggling with like, how do I really find these entry points, or where can I really make like the biggest bang for my buck when we're talking about risk-reward ratios, risk management, which we'll touch on in a second. And that is very easy to find basically, but you need to understand that you need to have the patience for it. Now, there's different ways to trade the market, and you need to find your own way. There is no one way that is best. There's 100 different ways to trade, successful different ways. The trick is to understand in which market situation the certain entry moments appear, how they look like, what they look like, how they form, what their average duration is that they will take off afterwards. This is the main thing, experience. That is the thing that you need, and you need to make sure that by proper risk management, your account will survive through the learning curve where you will make mistakes unnecessarily and will make losing trades more than later on. And this will allow you to stay in the game long enough to learn what you need to do differently than what you are doing right now. Risk management also refers to risk management during the trade. And this is something that people overlook. Because when you open a trade, you should not look at your take profit because it's completely irrelevant to what you're trying to achieve. You're trying to achieve making money. Yeah, but take profit goes with that, no? Yes, but the most important part is preventing losses and loss of money. You're not trying to control the winning side. The more you win, the better. The losing side is what you're trying to maintain in a steady, controlled set of parameters. Right? You want to have a limit to what you can lose in a trade. Now, we all heard about the 2, 3, 4, 5%. As you get more experienced, these numbers differ per trade depending on the probability of the success rate of the trade, your own confidence, fundamentals, and etc., etc. But at the start, what I usually tell my students is to start with no more than calculating your entry point to stop loss should not have a higher value than 3% of your max capital, because your entry points should always be that the stop loss to take profit ratio is at least 1 to 2 as starting point, with a projection of 1 to 4, 1 to 6, 1 to 12, etc., etc. Transitioning short into long-term trades. You can transition 15-minute trades into a day trade, into a week trade. It depends on how the trade develops as it goes. And as it goes, you need to control your stop loss. Move it to 0 at the right time to remove the risk from the trade, but to also make sure that if it retracts, that you're better off going out of the market 10 times in a row at 0, right, than closing them yourself at like 1/10 of the take profit that you were going to take, and you ended up with, let's say you're trading on a mini lot, for instance, and you close off at 5 pips and 6 pips here and 4 pips there and 3 pips here, these really small trades. But when you lose 30 pips, 40 pips, 10 pips, 15 pips. Like, the balance is gone. You need to kind of commit to these trades in order to keep the balance in, and this takes a lot of discipline because people have the feeling that you lose more than you win. This is actually not true. Most of the time, after analyzing a lot of trades from beginners and from students that when they first came to me, they're actually not trading that bad. It's just the decision making when to close and when to open trades is the problem. And more importantly, how to manipulate your stop loss in the correct way and when to do it. Trailing stop, for instance. Everybody hates trailing stops. It is a lifesaver when you're inexperienced, but you need to understand how to set it up properly, that it doesn't kick you out way too early every time. It only needs to kick you out if it deviates from the normal flow. This is all part of risk management. And I'll show this a little bit in practice a little bit later on. Now, talking about picking a direction, I mean, you know, a long or a short, in other words, a buy or a sell, put or call if you're binary. What you want to know, firstly, is what is the current market doing relative to the current trend? Meaning, if you look at a day chart, what is the current trend doing? Is it overall yielding towards a bearish or a bullish market? Which one is it? And from there, you know, is it a down or an uptrend? So from there, what you want to do is look at what is today doing and why is today doing that. Understanding why a market is moving a certain way takes a little time to research to understand why it does what it does. Because when you know why it does something, you can understand from extrapolating data from the past into understanding what it's going to do. You're not going to be trading this moment. When you open a trade, you're not trading now. You're trading the future. You're trading what it's about to do. So waiting to see what it's going to do is pointless because you're waiting to see what you should have been doing. Right? You're basically confirming your thought process, but you didn't act on it. Picking a direction for beginners, especially, the trend is your friend. I know it's a cliche thing that you've probably heard 100 times, but it is true. When you have a low account of like $2,000 and you are struggling with micro and mini lots, you need to stick to the trends. The occasional time that it breaks out of the trend line, if you have a proper stop loss with the proper risk management, it's not going to hurt you. On average, you will have a higher percentage of winnings because if you control, let's say, 3% of your capital per trade, right? And let's say from 5 trades, let's take it easy actually. Let's do 4 trades. Let's say you lose 3 of those trades. That means that one of them you won. And if your risk management is 3% per trade and your take profit ratio is 1 to 3, right? Then the 1 win covers 3 losses and you stay at break even. This is the important risk management. And we're talking about a 25% win rate. To be honest with you, a 3-year-old can reach that by simply clicking the random button buy or sell 4 times on different charts. It's literally a coin toss at that point. Statistically, it's almost impossible to do that bad. Now, I know a lot of you feel really bad now because, but I'm at that. It's okay. It's because you're over-analyzing what you think you should be looking at when you should be looking at it. And this will become a bit more clear a little bit later on. This is also a point that a lot of people forget. Fundamentals. A lot of people hear about, I want to trade fundamentals. That's, first of all, the worst thing you can do as a beginner. As a veteran, most veterans will know they have tried it and failed at it, usually. I've gotten lucky a few times, but you have to be honest with yourself. Okay, I got lucky. Right? I've had in the start that I did fundamental trading sometimes, and it yielded amazing results. But when I would be honest with myself, it was more luck than actual calculated, what I was doing. And that comes down to, first of all, what is actually coming up? That means that when you decide to trade, let's say you find something, you've done your analysis, okay, I want to do this trade. Hold on a second. Check. First of all, you don't know how long this trade is going to take. There's a way to calculate that, but we will not get into that. It's too complicated. Well, yeah, we don't have time. So what we want to do is, first of all, open up the economic calendar. Interbroker, economic calendar, or one of third-party sites, there's a plethora of them. Take a look at it, see what's coming up. Which are the volatile events? Is the pair that I'm about to trade having a news announcement today or tomorrow? And if it is today, when? If it's in an hour from now, is it smart to open the trade now? No, because it might spike the other direction that you were originally planning. It might accelerate the trade, but it may be a massive wick down or up, and then it retracts and then does the flow that you were predicting it to do. This happens a lot. So you get kicked out of the market. You take a loss where you should have taken a one because you were just too eager to start. Patience, psychology, patience. The market's not going anywhere. And as long as you don't have a trade open, you're not risking any money. It's better to wait and get the right entry moment. But when it's there, don't wait. Like, act on the moment. Don't wait for it to confirm what you think it's going to do, etc., etc. Just make sure you calculate all the variables before you open the trade. Right? Is it the right entry moment? Yes. Is the stop loss to take profit ratio at least 1 to 3? If the answer to that is yes, good. Now, is there any fundamentals? No? Perfect. Then it should just follow the natural flow. And then fundamentals. What do they mean? So I don't mean this in the essence, what does a fundamental mean? I mean, it's a news announcement of a statistical value of something, let it be the core sales or the retail sales of the month April. It's irrelevant. It doesn't matter what the number means. You don't even need to understand what the number signifies. Like if it's a 50 or 115, you don't care. The only thing you need to understand is what is the value of this news announcement, because what does this number actually represent? Not physically what the number means, but what the announcement means for the pair. An interest rate decision is one of the major ones. What does it mean? It means a direct reflection of how the bank perceives the current economy within the country. You need to know this. And more importantly, understand how a rate hike, a stall, or a rate or a cut affects a pair. For instance, this is a big thing that was recently, like, the Bank of England, for instance, on the pound. We'll go over the pound. Was very clear on it. We have no clue. With the new politics, with still Theresa May, we have no clue. So the interest rate decision, we're thinking about a hike, but as long as there's too many uncertainty, we're not going to do anything. And this came crashing down. So even though the interest rate got unchanged, which normally creates a positive movement for whatever the pair is, in this particular case, it caused a negative because of the reasoning why. And the reasoning is we have no clue what the economy is going to do in Britain, because we don't know what the politics are going to do. And on top of that, when you look at fundamentals, what do they mean? Is, let's say, retail sales. What are retail sales? And how important are retail sales right now for that pair, for the economy that that market is in? A good example is the NFP. The NFP 5 years ago, 6 years ago, would set the trend, literally set the trend for the dollar for a week. You could pretty much blindly trade for a week one direction. Pretty much, not entirely. Well, there were other factors, but it would almost set it would definitely set the tone where the general intraday would go to. Nowadays, it's more or less a spike on an hour, and then it kind of like ebbs down to about the middle, and then it stops there, unless it's a very big deviation from the expectation or from the past data. And that's because markets change. The importance of certain figures becomes less over time because it gets replaced by something that people are looking more at now. Something that had no historical volatility at this moment, so let's say 1 star or 1 exclamation mark, or whatever you want to call it, could become something with 3 exclamation marks 2 years from now. Because all of a sudden, that becomes extremely relevant to the market. All right, so trading fundamentals as a beginner is a no-go. And if you want to do it, I strongly recommend doing it either on a micro lot or go paper trading, demo account, and practice it, understand, analyze it, think about what you think it's going to do, then open the trade, then analyze by opening a trade from the history to see what happened, what you could have done differently. Did it match your expectations? And if it didn't, what didn't you get right? And why? If you're just going to, open the trade and it's like, oh, I lost it. Or, hey, I won it. Hey, I'm amazing. You're not learning. You're not improving yourself as a trader. You're just basically taking everything for granted, and most likely you'll end up at the bottom in the end of the run. It's like the house always wins. So now we get to fundamentals, the most exciting part for everybody. It's kind of like watching paint dry, but it is the core essential fundamental of your trading because it tells you what you need to do. So for this, we're going to go to CMSTRADER's Sirix platform right here. So here I opened up a pound dollar on the 4 hour. Okay, I have it listed for just the majors. So what we want to do here is a very simple look, and firstly what we want to determine is what is the market doing. So we're going to zoom out a little bit, and we can see here from the start of February till now, well, basically it's been an uptrend. You had the massive spike here. However, this big drop that we see here, and this is like details that you need to know about the pair, this was the election. So something that this massive does, what it really does is it shifts the market. Right? So in the big picture, it hasn't really broken the uptrend yet, but in the long run, this has shifted it. This accelerated the uptrend. This may have broken it. It's not back to the bottom yet, but it might have well be. Right? We don't know this yet, but it's still a very long way to get all the way back here to actually break the trend line that's going to be running over here, which I'll show you in a minute. But first, we need to have an understanding. So right now, lately, it's been selling off, a little bit, if we look at the average candle lengths, the downward candles seem to be a lot stronger than the up candles. Here we had a big change as it was a rejection. I'll get to that in a second with the analysis. And for today, remember this is 4 hours. So for today, it's basically been going down. So let's put it to a day for you to see that. All right, so it started as a positive day. It completely got put back into its place basically, and it's creating a dead candle. That means that, and we'll get to that in a second, as patterns. So let's now actually start doing some analysis. Now that we have a little bit of an idea of what's been going on, what the market's doing, well, first of all, I can draw a trend line on the top here, from here to, let's say, here, right? We want at least 3 connection points or more, right? That is what we're looking for, and clean. Trend lines do not cross the market. So this one would indicate that this can go all the way back up here before it needs to have a reason to push through, right? Either a fundamental or something else. Now, if we try to find a cross reference, well, the only one that we really have is over here. Yep. Whoops. Hold on. So something like this, but this is really, icky. It's very unclean. It's only 2 points. We can't really do anything with that. But what we do have is a potential channel. So you try to find like the cleanest points. So that would be something like this. So what does this signify? It shows us a little bit the bottom end of what it's been going over. So this is a little bit the bottom limit. Here we have a top limit, and we can extrapolate these a little further. We get a good idea. Now this is the big picture, and we have a diverging channel here. Basically, it's getting bigger and bigger in benefit of the downside, right? Because this thing is sloping down away from this one. If it would be a converging one, then it'd be towards each other. So in this case, it's showing that the downward trend is getting strong, and that makes sense because the value of the pound is getting lower. Consider it this way. When a pair is moving upwards, gaining strength, it's like climbing a mountain. Let's say it's Mount Everest. The start from 0 to the first, 1 kilometer is going to be a cakewalk. It's basically just walking up the mountain. But then the air gets thinner. It starts getting harder. You need to push yourself harder. So there needs to be more power within you or the pair in order to push it higher. And eventually you get to a point where you need help to get further. Climbing Mount Everest, you need tools, right? You need oxygen, you need stuff. In the case of a pair, they need positive fundamental news on top of the fact that the secondary pair, which in this pound dollar would be the case of the dollar, would need to get weaker at the same time because it needs to push beyond the limit that it's supposed to go. But still, there's a peak. Like Mount Everest, you can't climb higher than the peak unless you learn how to fly. Well, there's a rare occasion when this happens in Forex, but generally speaking, this mountain is the same thing. And these are price limits. And they also have a bottom. And this is where banks relate with that it will always stay within these extreme limits. But always is a strong word, because who can forget the Swiss re move, which was basically in January 2015, where our dear friends of the Swiss bank basically negated a 2-year standing bottom that they would not allow the Euro CHF to drop below 120. It was literally stuck at 120. It could not go up because the Swiss franc was just way too strong for the euro to compete against. But because the banks refusing sell, you could not sell the pair. You could not go down because it was not allowed. It was basically zero. And then in January they said, screw it. Sorry, we can't hold it any longer. We're going to remove the bottom. And that's what happened with the Swiss remove. It just completely crashed the market. It was one of the biggest market moves ever in history. If you don't know what happened, go into any Euro Switch CHF pair, go back to January 2015, you'll see something funny. Now, so we have the major ones. Now what we need to know is we're not going to be trading this. This is a massive gap. Right? You're not trading that. This is like 3-4 days to get there. I'm not going to trade now for 3-4 days. If it transitions into that, awesome, but probably not. So what you want to find out is the relative trend. And the reason I'm doing this in 4 hours is because it's the most stable. If you trade in 1 hour and 50 minutes, you still start in 4 hours, and then you refine. After you've done all the analysis in 4, you go into 1 hour and add your additional analysis. You follow the same rulings again. And then you go to 30 and 15 minutes and 5 minutes if you want to. I strongly recommend not doing that, by the way. 15 minutes is about the lowest you should go. So unless you want to scalp, but then you need a broker that allows that. So forget about that. All right, so now the relative trend is, well, lately, if we take this one, all right, so I put it on top of this, and hello, can we, yes, thank you. I take it over this. This is the only 2 point that I have, in addition to potentially, oh, come on, work with me here. Pulling it down. If I take it over the wicks, now you avoid the active candle. This was the previous, so that's fine. This could be the real, and you see that it's in line with this. It's exactly parallel to the bottom line. If I pull it back, these two are parallel to each other. So this is the channel that it's moving in, and this is just the top end. So this shifted the market into a stronger downtrend instead of an uptrend. This is not a rally. This is just a correction. Now, the other trend line that we have is the relative uptrend, which is here, and I'm taking this point and I'm taking the bottom here as a reference. Now, if we take the past, right, this was the cleanest line, 1, 2, 3. So that got broken. So I can now confidently say this is no longer a relevant trade. But you still draw it in the first place, just to make sure, because it was this line, but it got broken by these two candles. This broke it. And there's a rejection here, which brings us to entry points. So first we need to do resistances. That's the next point. And you see that I zoom in and zoom out a lot. And it's because I need to keep overview. I can't remember what happened there. I mean, I don't have a crystal ball. Well, the first resistance and support, well, resistance support, the difference that they throw at that, the one supports the trend, the other one resists the trend. It doesn't matter. It's a horizontal line, right? Just keep that in mind. And what they signify is it can change direction here or it stops moving here, right? It doesn't matter if you call it support or resistance. You can call it John and Pete. It doesn't matter what you call it as long as you understand what it does or what it can do. Now, we try to find, again, the most solid, and this obviously crosses through the chart, but you try to find, again, 3 or more connection points as solid as possible. So here we're looking at this. There's the bottom here. There's this wick that might be there, but we have here a whole plateau where the body stopped moving, as well as on the way back, it stopped moving there. This one kind of like a jiffy through it, and here it burst through. So this is a solid one. This is just the top end one. You could move it there. So the next one is going to be, oh, perfect. So it's right here. And for those that have a keen eye, you will start noticing one funny thing, that these distances are roughly equal. And that is not a coincidence. That's going to be the same all the time. Because the price, the resistance to support is a price point at which it needs to push through. They're like milestones that can break. Consider it like little gateways. It's a little gate that needs to open and then it shuts again, and it needs a reason to open the other way. It swings both ways, but it needs a reason to actually pass through. Like it needs an ID card, or whatever you want to call it. So moving on, the next one, and I know that some of you are going to say something else in a minute, so I'm just going to put this one in. You see it's roughly the same distance again, and the next one is going to be somewhere over here probably. We zoom out. Yeah, that's pretty much it. 1, 2, 3, 4. All right, so we have a trend. We have our relative resistances. Now, if I go to 1 hour, which is 4 is 4 divided by 4, right? So it's, that doesn't matter. Time frame divided by 4 is resistances time divided by half. Now you have your hourly resistances. And then the half of these are the 15-minute resistances. 1 hour divided by 4 is 15 minutes. You'll see this. This explains these little terms. Now this, I only want this one because it's relevant to where the market is right now. So now let's say you need to judge your entry point. Well, this was an entry point right here, which was hard to tell at that point. I will give you that. But you could have judged it by this resistance. And when you get a rejection, and let me zoom in on that a little bit, when you start getting this rejection, you see that it's starting to flatten out here, right? It started deviating from this line. It started getting flatter and flatter and flatter. And you also had the past data from, hello, yeah, thank you. If I would have moved, oh, come on. This, and where's that line? Here. So it's a bit squashed on this, but right, we had this trend line, what it was moving towards, which is parallel to that line. So we're starting to get here. This is where you start paying attention. Now this one was a little bit on the fly because you needed to know that the euro was going to have an announcement in a minute. And then that's why it changed direction. It's because of the euro news, which made the dollar weaker today. But remember, this is on an hour view now. So we're looking here and we see this rejection on what is now then a confirmed trend line because we have one candle. What is your decision? Well, if I would open the trade right now, that's the first question you ask. If I would open the trade right now, what is the probability that is highest to be in line with the major trend and what I am seeing right now? Well, what I'm seeing right now is that there's a rejection on the trend, and even if it would be an uptrend, then the relative uptrend, it would have been at the top of its uptrend channel, which would have been something like this, right? I'm taking this point, and this point, before this point. So even if it would have been this one, and I would be looking at the relative trend at that point, which would have been something like this, would have been something like this at that point, then, right, 1, 2, and could consider be maybe a 3. But we're talking about this candle. This, we'll zoom in now. This candle is what we're talking about, this green one, right? So it would have been at the top here that we know that there is a resistance right above it, and we have the first trend line here. Now this trade would be a bad trade because you have a very small distance because your take profit to stop loss ratio is very small, right? But what you can judge is when, okay, taking this out, leaving this in, by the way, taking this one out, if you would be here, right, and I take my sell right now, then I know that the stop loss is going to be above this resistance point, so it's going to be over here. So this is my distance, stop loss take profit, which would have been 275, like 20 pips, give or take, right? The stop loss should be relative to the market, not a fixed number that happens to fit you best. That's a really bad way of doing it. Now, you should manipulate your lot size to make the stop loss equal value every time, not make the stop loss equal distance every time to fit your value. It's wrong. I find it a wrong way to do it because you get a lot of stop losses that you hit because, well, you needed that little bit of extra. So if I would have it here and my entry point was here on this green candle, my sell would have been at least this point, which is at least double, I think. 274 to 270, so 40 pips. So 20 to 40, 1 to 2 ratio. Not optimal, 1 to 3 is what I'm looking for, but 1 to 2 is acceptable. I have a pretty clear that it's going to start going down at the start anyway, so I can move my stop loss to 0. And if it keeps going, I have a very clear. So in this case, you would have gone in here, would have put stop loss to 0. This spike would have knocked it out. But that's okay. Right? It's okay to go out at that point, but then you have this trend line to know that, okay, I can re-enter and do the same thing again because it got rejected again. or just walk away and like call it a day. So entry points are very simply said where resistance and trend line are together. This is when you look at the market and go, okay, the probability of it turning is bigger or smaller, yes or no? If the answer is yes, you trade the opposite direction of what it's been moving because it will get rejected and go the other way. This is a decision you need to make and not wait for it to start developing and start making this candle. Okay, I'm going to wait. Okay, there's a red candle. Oh, let me go in now. You go in here. I've been in since here because I just wanted to go in. It has to turn. All right. The only thing is, keep in mind fundamentals. So these are some basics. All right. So that said, I hope that was clear for everybody. Now, that's a lot of information in a very short time frame. I do hope that most of it was okay for you guys, that it kind of got stuck in your head, that you did get it. But look, Q&A session. Anybody, any questions? The chat is open. Let me just grab that, by the way. 1 second. There it is. So anybody that has any question, shoot. I am right here. Try to keep it related to the webinar. However, if it is something more generic but not directly related to the webinar, it's fine. I'll be more than happy. I will read out the questions out loud so everybody can hear it. The people that rather not want their question or want to just send me some feedback, go ahead, and negative feedback, I'll read it out loud as well. Criticism is good for the human body, so let's go. Okay, so we got one question. How do you judge when it's a long-term trade when you start short-term? The way that you judge that is simply from your entry point. If you get that nice entry point where it just goes right into your direction, you move the stop loss into 0 in time, and it keeps going, and it doesn't really deviate from the pattern that it's been doing, you can keep the trade open by just moving your take profit out of the equation entirely, or just move it to a ridiculously high point or low point, sell up by, and just move the stop loss every 4 hours underneath the previous 4-hour candle, but relative to the relative trend that it's been developing at that point. You always stay underneath that relative trend line, but you move with. So once it breaks it, that's the end of that relative trend, and you took the maximum out of it, almost. I hope that's clear. All right, good question. Anybody else? No. All right. So then again, I would like to thank everybody for attending today. I think the best tip I can give you all is practice. Don't get discouraged from a few losses. That will happen, especially as a beginner. Work on your risk management. Work on your psychology. And whatever you do, if you're having a bad day, know when to call it quits. Right? I don't mean call it quits on the account. I mean just walk away for the day. It sucks, but we all have to go through it. Learning when to just knock it off because it's not working out for you today for whatever reason. Right? You're thinking about the mortgage, the kid screaming in the background, a pigeon flew into your car window. That doesn't matter. Whatever the reason is that something is not, making you have your head in the game, let it pass. The market's still going to be there tomorrow, but if you keep going right now, your account may not be. Right? So that's the best tip I can give you, I guess. So thank you again all for listening. I would like to wish you all a very pleasant evening, and I wish you the best of profits on the market, and hope we meet again. Goodbye.